Now that's cumulative migration of people moving into these markets, most of which is Sunbelt. Just compare the cost to owning a home of about $2,200 versus the cost of renting of about $1,500 or close to $1,600.
They have outdoor lounges, swimming pools, gyms, coffee bars, etc. Not only are you paying less than you would if you had a mortgage, you're likely, kind of upgrading your lifestyle. If my money compounds at 12 to 14% for the rest of my life, I'm going to die a very wealthy man. Manufactured housing has come a long way in the last, 20 years or so. You hear about them in like old cowboy movies and stuff. You're not going to see maybe a cheaper company in the entire markets. I don't know who's going to buy Teslas anymore.
Tesla's a publicly traded company. I think he needs to act like he's running a publicly traded company. Hi everyone, it's Brad Thomas and welcome back to the Wide Moat Show. I'm joined today with my co-host Nicholas Ward. Nick, it's good to see you today.
Yeah, thanks. Good to see you, Brad. Sounds like you're feeling a little better than you did last week, so happy to see that. I know you had a tough time, and happy to be here. The markets are still kind of headed higher, so I think we're still near all-time highs on the S&P.
Yeah, I'm going to try to go at least. I may get one or two mulligans for a cough, but I'm going to try not to cough. I definitely feel a lot better this week than last, and it's good to be here again. And this week we've got another really cool episode this week. We talked about last week about answering subscriber questions or readers or followers, viewers questions, and we got some more coming. So keep them coming, and please drop us comments below because those comments turn into questions, and that's what keeps this show going and going, and how the followers keep going and going and going. So please follow us, comment below, and we're here today with some new questions.
Yeah, we certainly won't do these question episodes every week from here on out, but when the markets are at all-time highs, there's not a lot of value to be found. We have our newsletter coming up soon, and we're having to kind of really do a lot of work to make a pick for this month. It's just there's a ton of value back in April. Now there's not so much. So happy to answer these questions now on the YouTube channel and hopefully help you guys out. When it comes to making your own investment decisions.
I enjoy this show a lot because it allows me, and Nick, I'm curious with you, it allows me to continue to research a lot of companies. We might select some of those companies in our newsletter. Even this past weekend, there's a company that we just included in Wide Moat Confidential, which is one of our products here at Wide Moat Research. And one of the markets that this company was investing in is one of the companies that was recommended here we're going to be talking about here in just a minute. So it's always good because I can keep my brain going and really keep our research engines going full speed ahead.
Yeah, there you go. And so we'll get right into it, Brad. I'm glad you're here this week because we had several questions directed at you asking about the multifamily, the residential REIT space in particular. And I think there's 2, 3, 4 people that were interested in that area kind of the REIT sector. So I'm happy to hear what you have to say. Do you like residential REITs? Do you have a favorite company, a favorite subsector? Where does your mind go when you hear residential real estate? When we're talking about REITs, not physical investments.
Yeah, so I think it is definitely now is the time to own rentals today. There's a couple different drivers for this for these different companies. Now, within the residential real estate REIT sector, we'll call it, there's really 3 different categories. You have general apartments, and we have manufactured housing, which those companies also tend to own RV property, RV parks as well. And then you have the third category being the single family rentals, SFRs. And I think all of those really offer some pretty compelling value propositions here. Starting with, I guess we'll go here with one of the first tickers that was asked about is Camden Property Trust. Camden Property Trust, that ticker symbol is CPT. Now, what I like about Camden, again, when you go back to the fact that right now the housing market, housing affordability is elevated. I'm actually going to show a chart in a minute, which is really interesting comparing some of the affordability of owning a home today versus renting a home. But Camden, they own these apartment communities. These are high-end, really Class A apartment complexes. You can see on this chart, they're 93% of their revenue is generated from these markets that are in either have very high employment growth, very high population growth, or very high total migration. And of course, you can see here on the right, on the migration, these markets like Houston, and that's the company actually I was researching this weekend for Wide Moat Confidential. Look at the migration into Houston. That's the number one on the list, or Phoenix, or Dallas, or Tampa, Orlando, Charlotte, Austin, Las Vegas, Raleigh. So a lot of demand going into these markets. And again, these people that are migrating, first thing they're doing, they're going to these towns and they're like, wow, unless you've got cash to buy a home like Toll Brothers, and most of those buyers pay in cash, but most people migrate in, they don't have cash. They need a down payment. And then when they go to get their lender, of course, the cost today is much higher than it was before. I'm going to show you the next chart as well. This shows you the migration trends between the East Coast, the West Coast, and Sunbelt markets. And you can see here that top orange line. Look at that migration. Now that's cumulative migration of people moving into these markets, most of which is Sunbelt. Now I'm going to show you the chart here of Camden. Camden has a portfolio of about 60,000 apartment homes located in 15 major U.S. markets. You can see here the green area on this map. These are your major Sunbelt markets, dominant positions in Texas, dominant positions in Florida, Denver, Phoenix, etc. So I like Camden a lot. Camden has, in terms of their fundamentals, rock solid balance sheet. They've got an A rating, enterprise value, debt to enterprise value is just about 22%. Net debt plus preferred to EBITDA is about 4 times. And then again, they've got A ratings from Moody's, S&P, as well as Fitch. Strong liquidity. However, look at this next chart here. I'm going to use fast graphs. By the way, we use these about every week. If you're new to the show, this is a fast graph. Stands for Fundamental Analysis Software Tool. We love these because we can get through these Analyze Out Loud videos very quickly, very fast, hence the word fast graphs. This chart shows in terms of the history of the company, they've delivered very stable and predictable earnings and dividends over many years. But right now, valuation-wise, they're cheap. Now, they're not really cheap. I'm going to show you some cheaper ones in a minute. But Camden's trading at about 19.5 times. Their normal valuation is about 22 times. So again, there's a margin of safety, certainly worth considering. Dividend yields about 3.7%, which is just about in line with all of the other peers in the apartment REIT sector. And their payout ratio very healthy at 72%. When we forecast the company using the Fast Graph Forecast tool, we can see the projected potential, we'll call it, annualized return of about 14% over the next, say, 12-month period. That's an annualized forecast. So I like Camden a lot. If you want exposure to Sunbelt markets with all of these migration trends that I mentioned, Camden's certainly the pick. Next, I'm going to move over to Mid-America. Mid-America is really based in Nashville, and they own communities right here in my hometown of Greenville, South Carolina. They've got about 9 or 10 communities here in my backyard. Mid-America is a little larger. They got 104,000 apartment units spread across around 16 states. I'm going to highlight this map here. You can see major markets. And what they do is when they go into markets like Atlanta, Dallas, Orlando, Tampa, they don't just have one community. They diversify these communities. So they have these clusters within these major Sunbelt focused markets. So again, you've got these very sustainable trends. Now, this is the chart I want to show you next. You can see here the average mortgage payment from, say, 2020, just before COVID, till now, is up 111%. Mid-America's new lease prices are up only 26%. So today, when you move into, say, a Mid-America market, say like my hometown of Greenville, South Carolina, just compare the cost to owning a home of about $2,200 versus the cost of renting of about $1,500 or close to $1,600. So you can see this affordability trend is really a key driver in addition to the migration trends that I pointed out earlier. So I think Mid-America is definitely a company I like. I'm going to pull up the fast graph here again and show you in terms of their fundamentals. Very strong company, very similar to Mid-America in terms of their balance sheet. They're A-rated. Mid-America has a 4% dividend yield. 78% payout ratio. Again, trading at 19 times versus 19.7 is their normal valuation. So not really a huge bargain today in terms of Mid-America. Again, I wouldn't say you shouldn't buy it, but I would definitely maybe wait on a little tighter pullback, because you can see here on this next forecast, we're only forecasting about 12% returns for Mid-America. Again, it's good, great company. Maybe wait on a pullback for that one.
Yeah, I like these because you talk about the value proposition of renting versus owning. And oftentimes with these, Mid-America, Camden, they own B and A, rated apartment complexes, which means these are really nice places to live. They have outdoor lounges, swimming pools, gyms, coffee bars, etc. These are really nice places to live. So not only are you paying less than you would if you had a mortgage, you're likely, kind of upgrading your lifestyle. So yes, there are certainly benefits to owning your own home and kind of building wealth that way. However, there's also something to be said for, living, a better quality of life, paying less for it, and maybe investing the difference, right? I mean, you can look at charts that show buying your house isn't always the best way to go. And I do like these REITs too, because, I think you and I both agree, Brad, the Sun Belt is a pretty attractive place to be long-term when we're talking real estate. But I don't know, is Orlando going to outperform Austin, or is Austin going to outperform Nashville, or is Denver going to keep, growing faster than all of them? I don't know. So instead of having to buy one place or two in these places, most viewers of this show probably don't have enough money to go buy 2 or 3 or 4 or 5 rental properties. You can just go buy shares of one of these companies, get access and exposure to all of these fast growing markets. And, the CEOs and the leadership teams of these REITs, they know more about these markets than you or I ever will. And, I just trust them to invest new money where it should go instead of having to do it myself. So, and you don't have to deal with tenants, right? I don't want to have to deal with tenants. We've already made a video on physical ownership versus REITs. We both fell on the REIT side. And I do, when it comes to the Sun Belt, I think both of those companies are very high quality investments. And hey, 12 to 14% total return expectations, even with a kind of a narrow margin of safety, that's really good, right? If my money compounds at 12 to 14% for the rest of my life, I'm going to die a very wealthy man. So,
well, we're going to move up the curve a little bit. If you don't like the 12%, let me tell you something maybe a little better.
Okay, well, hey, better's always better. Let's go. What do we got?
Well, and nothing's guaranteed in life, right? So, at any rate, but manufactured housing parks. Now, I want to be clear. We have mobile home parks and we have manufactured housing. What is the difference? Well, the difference is a couple things. One is, manufactured housing is really built. They're built in factories. They're much better, well constructed today, given technology, than they were many, many years ago. In fact, you may know or you may not know, Warren Buffett has invested in Clayton Homes, which is one of the key manufactured housing companies today. And so manufactured housing is really what's really driving this is what I would refer to, frequently referred to as the silver tsunami. Now I'm moving into this population, by the way, this cohort, which is the 55 and older communities, which is expected to grow by a rate of 7.3 million people, 9% cumulatively over the next several years. So that's going to be huge in terms of the demand drivers for this space. Now, the second part of it is affordability. And again, we talked about affordability of apartment homes versus our more payments, rent versus owning a home, a mortgage payment. But in terms of the ownership, because most of the people that are in manufactured housing communities, and by the way, one other difference is manufactured housing communities have curb and gutter. Typically, they have amenities, swimming pools, parks, all types of stuff. These are
they get a bad rap, right? But you guys, Brad will mention some companies. Go to their websites. Type in X ticker IR stands for investor relations. You'll go to their website and you'll see the pictures they put up of these neighborhoods. I mean, they're really nice looking neighborhoods. I think the idea is too, they're safe, low crime, like-minded individuals all living together in harmony. Obviously the world's not perfect and that's not how it works out. But yeah, these aren't, trailer parks. Yeah, I don't want to insult anybody, but the manufactured housing has come a long way in the last 20 years or so, and now I'm not in that kind of 55 plus cohort. I can't qualify to live in many of these neighborhoods, but man, doing research and looking at these pictures, I'm like, hey, this would be a pretty good place to live, when it's time to retire.
For sure. Well, take a look at this next chart, and I'll talk about affordability. This is a chart comparing the price of a home today. You can see here $361,000 versus the cost of owning and renting in a manufactured housing community, $121,000. So there's a huge gap here, about a third as much as a traditional home in terms of the difference between manufactured housing and traditional housing. So that's a huge, really catalyst that we need to consider. And here's another part of it. These are pretty sticky people, sticky homeowners. When you move into a manufactured housing community, it costs to move that home into the property, stabilize it on the piece of real estate. And so typically that individual is going to stay there much longer. They've got an invested stake in the property. From the ownership perspective, you basically have a ground lease. So there's not a whole lot of risk at all to the owner of the manufactured housing. So it is one of the perfect, what I call, setups for sleeping well at night. Your ultimate kind of sleep well at night investment. Now, there's two companies here that I'm going to be talking about today. There's actually three companies, but the other one's pretty small. We're going to stick to the bigger names. Equity Lifestyle. Originally, that was one of Sam Zell's company. Sam Zell passed away a couple years ago. But Equity Lifestyle has 455 properties, 173,000 sites spread across 35 states as well as Canada. And so the company has a very good track record in terms of their fundamentals. They've delivered 14% annualized total return since their IPO, which ranks in about 85 percentile of REITs over the last 10 years. And they've delivered a 211% total return over the last 10-year period. So very solid operating history, very strong balance sheet, 19% debt to enterprise value, 4.4 times debt to adjusted EBITDA, 19% of debt that is fully amortizing. I'm going to pull up this next slide here. This is their dividend and FFO growth history. This is almost really an incredible history, especially when you compare it to the REITs. You can see their normalized FFO growth is about 8%, but importantly, their dividend growth is about 20% CAGR, going back to about 2006. Very stable. I've got their fast graph chart up in here. You can see very stable. Again, operating history, valuation. It's not a dirt cheap kind of operation. We do think the shares are trading at a pretty slight discount. And I'm going to pull up this next fast graph here. Potential return, if we move back to normal valuation, is about 24%, 20 to 24% on an annualized basis. So again, when you move up from apartments now to manufactured housing, we're seeing those discounts. A lot of those discounts are really related to just the overall market in general. Obviously, there's been some fear too on the RV side of the sector because it's a very transient type business model. Now, I'm going to move over real quickly to the next one. Sun Communities. This is my highest conviction within the apartments and manufactured housing. Sun Communities, we've actually covered Sun Communities quite a bit here at Wide Moat Research. What's happened recently is the company sold off their marina business. The marina business was probably a bad bet, frankly. And they ended up selling that business to Blackstone for about $5.65 billion. Now, what they're utilizing with this cash is, for one, they paid a special dividend. It'll show up here in the fast graph here in just a minute. And then they are going to use that cash to fund new acquisitions, share repurchases. They're also looking for a new CEO who's retiring. So we'll be on the lookout for that. And they're refocusing now their operations. Now that they're out of the marina business, they're going to be 100% manufactured housing and RV, just pure play. They've got around 175,000 individual sites spread across 500 communities. So this makes them the largest publicly traded manufactured housing and RV community owner in the world. They also have a very small slice of properties in the UK, about 53 of these holiday parks, which is just, again, a very small slice of that business. Now let's pull up the fast graph here. This is the one I like of all those I mentioned the best. Sun Communities trades at 21 times versus their normal about 24.8 times. So a little good, really better kind of margin of safety. Dividend yield is about 3.3%. Again, they had to cut the dividend After they sold, the revenue went away for, as I mentioned, they sold to Blackstone, the marina business, but the payout ratio is very healthy now, of course, because they reset the dividend. It's about 69%. When you look at the next chart, fast graphs, again, we think there's definitely those catalysts in place that I mentioned, and the company has a really good setup to deliver really record-beating returns of, as shown on the screen here, 28% on an annualized basis. So of all those four, I really like Sun Communities the best.
Awesome. Well, Brad, you got like 1 minute to talk about the individual single family homes. Do you have a favorite in that spot? That was something people ask about as well.
Yeah, I like this sector a lot. Again, got a lot of the same demand drivers we're talking about. People can't, they can rent cheaper than they can buy, right? So we have American Homes for Rent and we have Invitation Homes. I would say right now, like American Homes for Rent, 60,700 individual home sites spread across 30 markets in 24 states. Really quickly here, this is the fast graphs of American Homes for Rent, trading at 22.4 times versus the normal valuation of 27.1. They're still growing, and consensus growth is still very solid, 5-6%, 3.3% yield, 73% payout ratio. Again, we'll pull up the next slide here. Another fast graphs. Total return forecast here on this one's about 19%. So not as strong as we're seeing in the manufactured housing sector. But again, I really like the single family rental business. I think it's a great business. I would rather them do it than me do it. They've got the scale advantage. This is the key really for owning REITs, is having that scale advantage in general. But all of those names, I like American Homes for Rent.
Yeah, I got to imagine they probably have a lower cost of capital than most, Main Street type of investors like you or me too. So that should kind of enhance their returns. So guys, now we'll pivot away from REITs. There were some questions kind of pointed towards me about a few other types of companies that I'll hit really quickly. And they are interesting. We talk about value a lot on this channel. We definitely want to buy things when they're cheap. We'd rather buy them low and sell them high than vice versa. And somebody asked about Western Union, which I'm going to be honest, it's not a company I follow. You hear about them in like old cowboy movies and stuff. Apparently the company's still around today, Brad. I don't know if you knew that, but
I did not know. I think years ago when I was in high school and I ran out of money and I was down at the beach, I think I called my mom and I said, "Mom, can you send me some Western Union money?" That's the last I heard about Western Union.
People still do that, apparently. I thought you would use, a Venmo or even a crypto wallet or something these days. Apparently, people still use Western Union. They still have a $2.6 billion market cap. So I think, I don't follow it closely, so forgive me if this is wrong, but my understanding is this company, they cater towards unbanked people, and a lot of that happens in emerging economies these days. So the company is very cheap. I don't know who asked about this, but looking at the fast graphs, which I'll throw up on the screen now, you're not going to see maybe a cheaper company in the entire market. This Western Union is trading for 4.5 times earnings. Their long-term average is 11 times. So, I mean, you're looking at a 60% plus margin of safety. Mean reversion, this is a $8 stock right now. If the stock was to trade up to its long-term average, we're talking about a $20 stock. You're talking about massive triple-digit upside in the relative short term. So I can see why people would ask about this, but it's not something I'm interested in. Yes, deep value. If you have conviction that Western Union is going to exist for another 10 to 20 years, by all means, this is probably a huge upside play here. My issue is all these unbanked people. I mean, the reason that they're cheap, everything related to crypto is just crushing the sentiment here, and maybe the business, right? I have to imagine it won't be that. It'll be easier just to transfer things digitally moving forward with crypto, or like we said, with a Zelle, with a Venmo, etc. So no, this is not something I'm interested in. I think it's what I said in the comments. It's a deep value play, but I'm not interested in deep value as much as I am consistent growth. So with that said, in the payment space, I do have a couple of alternatives that I would be interested in. One is American Express, credit card company. Everybody knows this brand. It caters to kind of the wealthy individuals. Because of that, there's a lot of spending on these cards kind of throughout economic cycles. Even when recessions happen, millionaires and billionaires still spend a lot of money. Very consistent earnings growth. No is not perfect. You will see some red numbers on the bottom of this fast graph here. But in general, this company's its earnings are moving up and to the right. So is its share price. And most importantly, so is its dividend. That's something that Western Union can't say. They haven't grown their dividend since 2021. So when I see that happening, they had been growing it for a long time prior to that. But when that management team stops growing the dividend, what they're telling me is they don't even have a lot of confidence in the business long term. Otherwise, they would continue to do that. So I like American Express as an alternative company, trading for 20 times and not 4 times. So you're paying a lot more, but it's got much better growth. And then if you even want to pay even a little more for even more consistent growth, I like Visa. Visa is a credit card company, but it doesn't actually offer debt. So it's not something where you have to worry about defaults and things like that. Visa just collects money when people use their cards. It's like a toll booth. Every time you swipe that card, they're collecting, fractions of a penny. But when there's like 10 trillion transactions a year, that really adds up. Visa has a near perfect EPS growth rate since turning public. The only down year was 2020. And we all know why that happened. People couldn't travel. They couldn't leave their house. So obviously they weren't spending a lot of money, and they certainly weren't swiping their cards as much as they had prior to that. Visa's trading around 30 times, but very consistent double-digit growth. I would much rather pay 30 times for a company that's growing at 10 to 15% a year than pay 4 times and just pray that a company survives. But that's just me. So that's my take on the payment space. Western Union, very interesting company. Whoever brought that up, I'm happy to have looked at it. I learned a couple of things, and it is very, very cheap. That's just not the type of things that I typically invest in. That'll lead me to another one, Tesla. Somebody asked about, and I think Brad and I can agree on this. This is also not the type of company that we typically invest in. Highly, highly speculative valuation. Company's trading for like 160 times earnings. That's been the case for a decade. And if you bought Tesla 10 years ago, you're probably retired today. You're very rich. Congratulations. My issue with them is I feel like it's hard to be like a Tesla fanboy because of all this Elon Musk political stuff. He kind of alienated the left when he, got married to Trump in the election. And now he's kind of butting heads with Trump, and he's sort of alienating the MAGA folks. I don't know who's going to buy Teslas anymore. I'm worried that he's really ostracizing a big part of his fan base. And and that's why the earnings are down. If you look at this chart here, Tesla has not grown earnings in a few years, and its car sales are not doing well. This is a company that people are hoping turns into a robotics company it's like the Jetsons, and we all have a maid in our house. It's a robot, and all the factories have robots, and there are robots everywhere. That's going to happen. I think any kind of big investment banking firm, you look at their reports on robotics, it's clear that humanoid robotics in particular, but just all sorts of robotics are going to essentially take over the world. And then a lot of blue collar labor is going to get done by them, a lot of transports, a lot of logistics, and just even maybe doing the dishes at home. My problem is I don't know who's going to win that race. I don't know if it's going to be Tesla with the Elon Musk product, or if it's going to be, what Hyundai owns, Boston Dynamics, I think is the name of that company. They're famous for that like little dog looking robot that can do flips and everything. There's a lot of people investing a lot of money into robotics, and I don't know who's going to win. And I feel like eventually these things are going to be commoditized anyway, right? Like even if Tesla creates the perfect human form that can tie your shoes and do your dishes and put your kids to bed, ultimately, other people are going to do that too. And I think the software is going to be where the money is in that industry anyway. That's kind of how technology always goes. Hardware gets commoditized. Software is ultimately where the margins can be found. So that's kind of my worry. Maybe Tesla will do both. They'll own the entire stack. I think that's their plan. And that's why the stock's trading for so much. People think they can succeed and make that happen, but too risky for my book. I'm not trying, they have to grow earnings at 50% a year for a decade to justify this share price. And maybe they can do it. Maybe they won't. But that's too many maybes for me. When I invest, I don't like maybes. I like, much more sure things. So Tesla's not something I invest in. Not likely something that people are going to find in a Wide Moat newsletter product. But, maybe who knows? Who knows? Maybe one day they'll come up with a product that's so good that we can't deny them. So, Brad, any thoughts on Tesla or Western Union before I go to the last question here?
Yeah, so I agree with everything you said on Tesla. I mean, there's a book right here behind me on my shelf called Winning Investors Over. And, maybe one of these days I'll send a copy of that to Elon Musk. I don't know if he would read or if he would really learn anything from this book, he should. And I've sent this same book to many, many CEOs over the years, especially those that I felt like are really doing a lousy job and they don't understand how to win investors over. And I think that's really the biggest problem, I think, with Elon Musk is he doesn't really grasp the concept of winning investors over. He's great. He's a smart guy. He's an entrepreneur, whatever you want to call him, the modern day Albert Einstein. But I've driven his products. They're okay. I'm not a huge Tesla fan. I've got my Porsche Panamera parked out here. And I jack it up beside a Tesla every other day when I'm driving around town. And I think Porsches are much, much better performing cars than Tesla. So I fully support everything you said there. I think management does matter. If you're a public company, I mean, this is, Twitter's private, so, he can do whatever he wants to do, or X, but Tesla's a publicly traded company. And I think he needs to act like, he's running a publicly traded company. So fully agree with you.
Well, Brad's harsher than I am. So there we go. Yeah. But the car sales are not doing great for Tesla. The Cybertruck has basically failed. And like I said, I don't know who's going to buy these products. When you make enemies out of half the consumer base or more, it's hard to sell a product. The last one is Whirlpool, which is a brand I think everybody knows. They make washing machines, dishwashers, refrigerators, just all sorts of home appliances. For years and years and years, their fundamentals were doing great. Their dividend has been growing and continues I think it had a 10+ year dividend growth streak. But like Western Union, they've paused that dividend growth recently because their fundamentals have deteriorated massively due to interest rates rising and tariffs happening, and more recently kind of hurting their manufacturing base, which is largely offshore. So this is another company trading for less than 10 times earnings, about 9 times. It's got 4 consecutive years, as you see on the fast graph here, of negative double-digit EPS growth. So I hate to see that. That basically crosses it off my list. That's certainly not consistent growth. And the argument here is, hey, the stock's so cheap, any bounce back at all will result in strong upside. And we see it wasn't long ago, this company was trading for $250 a share. Now it's at 90. So as a value play, I like this more than Western Union. I think in 10 years, there will definitely be Whirlpool refrigerators. I'm not sure that people will be moving money with Western Union. But it's still pretty volatile. It's economically sensitive. People don't make these big purchases when recessions happen. It's interest rates have a big play too. Every time you buy a new house or you build a new house, you put a whole bunch of new appliances in. When rates are high and construction rates are low, that's hurting demand. So analysts are calling for not a good year this year, negative 25% growth, but next year in 2026, 17% growth. So I don't know exactly why that is. I think they're expecting interest rates to fall, construction to boom, people to maybe who have been putting off these big expenses, which are often fueled by debt, to make them when rates are more attractive. So it is interesting as a potential kind of bounce back candidate. I love this, but for me, I would need to see the dividends start to grow again. I don't invest in companies that have stagnant dividends. I need to, at the very minimum, see that dividend growing at a rate that's above inflation. So this is interesting. It's on my radar now. So thank you for bringing it up. It's a company I followed in the past. And then when the dividend growth stopped, I stopped looking at it. I didn't realize it got so cheap. It's less than 10 times earnings. That's pretty attractive for a brand name like this. But I'll give you kind of a industrial name that I do like, and I'll go with Otis Worldwide. They make elevators. I'm sure anytime you've gotten in an elevator, I think there's only a couple companies that make them worldwide. And I like them not because they manufacture the elevators, but because what they do, they build the elevator, they put it in the skyscraper, and then they make you sign up for like a 30-year contract to service that elevator, because an elevator doesn't do anybody any good if it's not working or if it's not safe. So those service contracts kind of even out the earnings growth. No matter what the economy is doing, no matter whether or not new skyscrapers are being built, their existing installed base is generating them reoccurring revenue. So this is almost like an iPhone model. They sell you the iPhone and then they connect the services bit to it, and that results in very reliable earnings growth. So as you can see, this has only been a public company for a few years. This was a spin-off company, I think from Honeywell a few years ago, or might have been United Technologies. Like these kind of big and conglomerates all stick together in my head. But anyway, very reliable earnings growth since it's gone public, and that's expected to continue. 25 times earnings instead of 9 times. I get it. You're paying a premium here, but it's my mantra. I'd rather pay up for a wonderful company for reliable growth than make that deep value investment. So this is, an interesting company, I think, in the industrial space. It's a little undervalued relative to its long-term average. And when I say long-term, I just mean 5 years because that's all they've been public, but very reliable growth. We're not going to stop servicing elevators, for the history of mankind. And we're only building more and more skyscrapers. So that's my pick. And the dividend is still growing rapidly. So Brad, I think that's all the questions for this week. I'll give you the closing word here. And I will echo Brad saying, please like and subscribe to the video and continue to leave us questions. And it might take a couple weeks, it might take a month, but we'll get to them and, we'll add them into videos like this moving forward.
Great. Thank you, Nick. And yeah, there were some more questions, but we'll add those to the next week and the following week or following week. Please drop us any more questions. That'll keep us going. We like uncovering these new companies that we've never heard of. Give us some good ideas too here for Wide Moat Research. So thank you for joining us. We look forward to seeing you back next week. And happy Swan, sleep well at night, investing.
Yep. Happy Swan investing. See you guys.
Thanks for watching this episode of the Wide Moat Show. Please like and subscribe below. And also, please join us at the Wide Moat Daily for our dose of daily news. You can visit us at widemoatdaily.com. Thanks for watching us. Have a great day.